Everyone thinks credit is about being responsible with money, that if you spend less, pay on time, and avoid debt, your credit score will naturally rise. That belief sounds logical, it sounds fair, and it sounds exactly like what the system wants you to believe. But here's the uncomfortable truth. Most Americans destroy their credit before they even swipe their first card. Not after years of debt, not after missing payments, not after financial disasters. Before any of that, no debt, no late payments, no reckless behavior, just silence on confusion and rules they were never taught. And once the damage is done, it doesn't disappear quietly. It follows them into car loans, apartments, insurance rates, and job applications. Sometimes for decades. Picture this. You finally get approved for your first credit card. Maybe you're a student. Maybe you're an immigrant. Maybe you're just starting your adult life. You feel proud, responsible, relieved. This little piece of plastic feels like a milestone, like proof that you're doing something right, so you're careful. You don't go crazy with it. You don't max it out. You don't buy anything flashy. You use it for small things. Gas, groceries, maybe a phone bill. You pay it on time. Every time you avoid debt because you've been told debt is dangerous. You've been warned your whole life to stay away from it. Months go by. Then one day you check your credit score and it's disappointing. Not terrible, but not good. Not what you expected. Lower than you hoped. Lower than you were promised. And there's no explanation, no notification, no warning, no breakdown that actually makes sense. Just a number. And that's when the doubt creeps in. Am I already bad with money? Did I mess something up? Is this just how the system works? Here's what banks, blogs, and most financial advice will tell you. They say credit scores drop because people miss payments. That's the story everyone hears. It's simple, it's clean, it has a clear villain. Miss a payment, your score drops. Pay on time, your score rises. Do the right thing and you'll be rewarded. That's the official story. But it's incomplete. Because while missed payments do damage credit, they are not what destroys. Beginners, what ruins credit early on is something much quieter, something invisible, something that happens even when you think you're doing everything right. Here's the part no one explains clearly. Credit scores are not about responsibility, they're about predictability. Banks don't care how careful you feel. They care how mathematically predictable your behavior looks. And the system is built to punish beginners for rules they don't even know exist. 3 invisible forces quietly shape your credit from the very beginning. Credit utilization, account, age, and timing. None of these are intuitive. None of them are explained. When you're approved, and all of them can hurt you without a single missed payment. Let's slow this down. Imagine your first credit card has a $500 limit. $500, that feels small, but it's normal for beginners. Now imagine you spend $300 on it, not on luxury items, not on impulse buys, just normal expenses. You plan to pay it off. You have the money. You're not worried in your mind. This is responsible behavior. But to the credit system, something very different just happened. You used 60% of your available credit, and that one number changes everything to you. $300 is manageable to the system. 60% utilization is a warning sign. High utilization tells lenders. One thing. Risk. It doesn't matter that you plan to pay it off. It doesn't matter that you always pay on time. It doesn't matter that you're not in trouble. What matters is what the data shows at the moment it's reported. And most beginners don't realize this because no one explains it when they get approved. The bank doesn't say, by the way, if you use more than 30% of this limit, your score might drop. They don't say, even 1 month of high utilization can hold your score back. They let you learn the hard way. And here's the part that feels unfair. You can pay your balance in full every month, still hurt your credit if the balance is reported before you pay. That's not a mistake. That's how the system is designed, and it gets worse. Because utilization isn't just about 1 month, it's about patterns. If your card repeatedly reports high balances, the system learns something about you. Not that you're irresponsible, but that you rely heavily on credit, and reliance is risk. Now, let's talk about time. Because time is the most misunderstood part of credit. Your credit score loves one thing more than anything else: history, age, time. Passing without drama, new accounts are treated like strangers. You might be perfect, but without history, you are unproven. From the system's perspective, you haven't earned trust yet. That's why beginners often feel stuck. They do everything right. They avoid mistakes. They stay disciplined, but progress feels painfully slow. Months go by and the score barely moves. And that's not because you're failing. It's because credit rewards patience more than effort. You can't rush trust. And then there's timing. This is where most beginners get hurt without realizing it. Here's a truth that surprises almost everyone. Paying your card after the statement closest can still hurt your score, even if you pay in full, even if you never pay interest. Why? Because the credit bureaus don't see your payment first. They see the balance. The balance is reported at a specific moment, often before your due date. So if you wait until the due date to pay, the system may already have recorded a high balance to the algorithm. It looks like this high balance, high utilization, higher risk. And then, days later, your payment shows up, but the damage is already done. No one explains this to beginners. No one tells you that timing your payment matters just as much as making it. And this one misunderstanding alone can stall progress for years. Because early credit behavior sets the tone. It becomes your baseline. It influences limits, rates, approvals, and rejections. And the consequences don't stop at a number. A lower credit score doesn't just affect borrowing, it affects real life. Car loans become more expensive. Apartments become harder to get. Insurance premiums quietly increase. Some employers see you as a risk, all because of mistakes you didn't even know you were making. This is why so many Americans say the same thing. I did everything right and still lost. And they're not wrong. The system doesn't reward good intentions. It rewards understanding. And beginners are almost never taught the rules. Here's the irony: people who barely use credit often struggle more than people who understand how to use it strategically. Silence doesn't help your score. Avoidance doesn't build trust. Credit wants activity, but controlled activity. Predictable behavior, low utilization, consistent payments, time. That's it. No hacks, no shortcuts, just boring consistency. If you're starting out, the real rules are simple. Keep your utilization under 30%, under 10% if you can. Pay before the statement closes, not just before the due date. Keep your oldest accounts open. Don't chase perfection, chase predictability. Be boring, because boring is safe, and safe is rewarded. Here's the truth no one says clearly. Credit isn't about money, it's about behavior, timing, and patience. Most Americans don't fail at credit. They were never taught how the system actually works. And once you understand that, the system stops feeling rigged. It stops feeling personal. You stop blaming yourself, and you start playing by the real rules. In the next video, I'll show you the single first credit card mistake that ruins more Americans than anything else. A mistake that feels harmless, sounds responsible, and quietly benefits banks every single day.